I'm very glad that today we have a wonderful panel of experts who will help us answer the question, what will actually change now that we have so many institutional investors in the game? And let me go just from left to right to give you a quick introduction. You don't have to clap after every name, we'll clap after the last one. Laurent, you're joining us from Standard Chartered in Luxembourg. You've been in the banking industry for 30 years and you're still wearing a tie, so it's great. And you've been and you've been very active understanding and teaching awareness of blockchain industry among traditional players. You're also a long-distance bike rider. You just told me you've been holding a biking license for 30 years. Who would have guessed? Stephanie, you're a South African banker who decided to move to Stuttgart. I mean, that's quite a change from South Africa to Stuttgart to Boerse Stuttgart. You're heading there the business development and partnership space. You're also an ultra-marathon runner, which bodes well for the crypto industry, which sometimes takes longer than we all expect. So thank you for coming. Andy, you're the founder and the CEO, and we just heard about your company of the digital infrastructure platform Wyden in Switzerland, and one of the key promoters of digital asset banking in Europe. One can say that you do have indeed a long-term view because you've been a fighter pilot, and as you told me earlier, you've also been a spy. So you got information that we don't. We want to hear it. And finally, Clarisse Hagege, am I pronouncing it correctly? Hagege. You're the founder and CEO of Dfns. They also have a stand outside. I've seen a custody technology provider for for banks, crypto custodians, and fintechs like Stripe. Most remarkably, securing over 1 billion in volumes every month. You've been educated in the traditional banking system from Crédit Agricole, and your sport is raising money. So far, you've raised 30 million from investors. So thank you everybody for coming. It's a pleasure to have you here. Now, I hope we'll have a controversial discussion today, because if everybody agrees, I'm probably not asking the right question. Laurent, if I may start with you, sitting just next to me. You've been in this business so long, so you know how slow the old world sometimes can be. What do you think will change with the influx of institutional players in the crypto industry?
Everything.
Just keep on talking. They will switch. Turn it on.
Is it okay?
Can somebody take care of his mic? The guys up there, they're struggling. Otherwise, take mine for the moment.
Yeah. Is it okay? Okay. Now you understand why I spent 30 years in the banking industry. So I'm not able to open a mic. So now I have to say that everything is going to change because, yes, you were speaking about the influx from the asset management. So we have seen the recent launch, not so recent, it's a year now, for the 12th ETF in US. So we have ETP already in Europe since a while, since 4 or 5 years. So we can see that the institutions are coming from the asset management industry. It's not yet the case for UCITS, because we have a big potential with the UCITS funds for having exposition in crypto, but we have to wait a bit of time. A bit of time is 4 or 5 years, probably. So it's coming. It's coming also for the bank broker dealer, as we were talking before. We see more and more private bank. It's not only in Switzerland, but now it's coming across the globe, in US, in Europe, in Asia, and a lot in Emirates. So we see a lot of things happening. So I have to say that yes, crypto is coming to the institutions, and banks, they will not have any reason to move forward in the future. So it's coming now or never.
Thank you. Stephanie, the big question when you have a disruption in an industry is always who will win? The incumbent players who have the distribution power, or the new ones who have the agility of the speed, who have the technology? What's your take on that? Who will win? Will it be the traditional players or the new entrants?
Well, I think that a statement like XYZ is never going to compete with us is something that never ages well. So the banks or traditional financial institutions can't afford to be complacent with new players coming into the space. However, they really have the leading advantage. They have the existing client base, they have the trust, so it's their game to lose, really. Something that we've looked at within Boerse Stuttgart Digital is based on the trading behavior in our own retail app. We think that there's a 2 billion revenue opportunity for banks to go into the space by 2030 within Europe, 2 billion euros. And so really the incentive is there to get in, and I hope I don't get struck by lightning for saying this, but it's just about being a bit more American in the approach, right? So we talked about the ETFs. Don't just have a product, distribute the product, push the product, and then I think it's for them to win.
Thank you. And Andy, you've been in this business.
And, yeah, we need to have discussion, you said.
Yeah, but I'd like to have everyone make a statement first. But since you're so anxious, please go ahead.
Just a second, she was talking about ETF, but we should not forget about tokenized money market and tokenized product.
All right. Andy, you've been in this business for a very long time. What role does technology play in making crypto accessible to institutions and friendly for institutions?
First, a little correction. I wasn't a spy myself. I did, however, lead projects at the Swiss intelligence agency, which is a little bit smaller than the US CIA or NSA. You know, I could tell you all about it, but then you know what I would have to do.
Come on, the spy story is so much better.
So back to your question, technology. I mean, blockchain technology, digital assets is a new field. You know, it involves new technology, and banks are and institutional players are not familiar with that technology. So obviously, that has a big learning curve. You know, we need to fit this new technology into the existing landscapes, into the existing processes. One key challenge is if we compare traditional assets to crypto assets. Traditional assets, you know, the master of data is within the banking system, your core banking system. With blockchain-based systems, that's not the case, that the master data is the blockchain itself, and banking systems are merely replicating what's on the blockchain. That's a paradigm shift that we often see institutions are struggling with.
Okay. Clarisse, what is, if I might start with something which might spark a discussion here, but what is the most unexpected lesson traditional financial giants have taught the crypto world, or vice versa, that is really changing the market infrastructure right now?
I guess, I guess for me, it's the way I see it is pretty much to tell crypto, to tell fintechs that are building in crypto not to reinvent the wheel. Things have been built for the past 30 years, and yes, we're introducing a new technology that is a breaking change, but this is not a reason to start operating very differently than we were before. When you look, for instance, at the Bybit hack, and when you're actually trying to analyze how it happened, one of the main reasons, and the first reason why it happened, is for lack of corporate security. It's not because of the smart contract was not well audited, right? So I think that's kind of a massive lesson, which is we've been operating in some constraints that that have led to building huge financial markets that are working, and so we need to go back to those fundamentals. And I think that's kind of one of the lessons that to me is super important to pause on if we want to save some time in building this industry. If we don't want to, you know, take one step forward, 3 steps backwards, pretty much.
I wonder, should people buy a Coinbase share or a JP Morgan share in the future? Laurent?
Why not, if I can make money? It's my personal reason.
But which one would you rather buy? One who comes from the crypto as a crypto native company, or one that is trying to adopt crypto technologies?
This is a very good question. It's a personal question, but anyway, if I need to answer, I will just need to see who will be the winner in terms of strategy for the future, and I can make a mix. I will buy a fraction of tokenized half Coinbase and half JP Morgan in this case, if I may. Is it a good answer?
That's the banker in you speaking. Stephanie, any view on that? Which one would you buy?
Depends if you want dividends or share price appreciation.
Say again, if you?
It depends if you want dividends or share price appreciation. So I'm with Laurent, 50-50, on the fence.
I'd say it doesn't matter, but I would like to see more people actually buying tokenized shares and trade them on regulated markets when they become available, because that use case will be driving our industry, right? So far, it's all been crypto. We haven't really seen, the market for tokenized assets. So hopefully, people will start buying these tokenized shares.
And I kind of, I'm with you on this answer. In my opinion, it depends the age you are, where you're located, what you're trying to achieve, right? And tokenization is all about access, right? So it's going to be about the type of product that we can actually build to build a financial market that is much more inclusive. So if you're 35 in Latin America, you're probably going to buy those tokenized assets, yeah.
I mean, it's interesting because crypto was all about decentralization, and now the big banks and big players come into the play, and they centralize it. They make it boring. Is that a good thing or a bad thing? Who would like to take that?
I think it's a bit of both. We have these large institutions coming in like BlackRock. They bring stability, regulatory compliance, capital, the risk management, and the way they work is centralized fashion. So that's the one side. But then we have the whole DeFi world with a lot of innovation, a lot of new use cases that are driving our business. So it's a bit of a coexistence of both. We need both. There are certain use cases like the ETFs in the US and institutional custody. They're going to be centralized, but then other use cases will be decentralized.
So I'm working for a big bank, and I always say that it's always better to share a big part of the cake with several players, rather to have just a small piece and be alone. So I believe that there is place for all the different players, whatever they are centralized or decentralized. And when you are talking to the giant in the asset management, in the banking industry, in the corporates and so on, they want to work with trusted partners. They want to work with banks that already have the coverage, that already have the securities experience. They want to have to work with the traditional players. But the way it's not the case for the crypto native player and for other small asset managers. So I think you have the place for the traditional financial industry that is entering to the crypto and also to the new industry. And we are not boring in the financial industry.
And maybe just
Stephanie?
Yeah, I stole one from the other side and then also broke it. Maybe it's me, Laurent. Is that working? So if you talk about centralized and decentralized, I think we've all seen that grid by now where you have centralized, decentralized, regulated, unregulated. And I think the only point that I would add is that we know where the dangerous quadrant is, right? So if you're centralized and unregulated, that's a mess. Completely decentralized is great, and centralized regulated is great. But even within traditional finance, you sometimes have challenges where it's not entirely clear, right? The system is not either completely centralized or decentralized.
Yeah, and I think that at the end of the day, it was in the beginning a lot about the infrastructure, right? Centralized exchanges, centralized organization came to the market just because it was hard to interact with DeFi, and it's still hard to interact with DeFi. And so there's a barrier to access. If you're a tech-savvy person, you're probably going to be able to access DeFi products, have less counterparty risk beyond, sort of one-to-one type of model, and enjoy the benefit of DeFi. Otherwise, it's still very hard to access. So in my opinion, it's, as you were saying, it's a counterparty risk, but it's also a question of infrastructure and our ability to build an infrastructure that feels safe, where the UX is actually easy to apprehend. And we'll see more combination of both then, in my opinion.
I mean, for those of us who have been to the Crypto Asset Conference for a few years now, some of these topics, that they're like, what's the Groundhog Day? They keep coming up. Every year people talk about, yes, fund shares will be tokenized and all of that. It just feels that nothing is happening. Is that a wrong perception, Andy?
I like that analogy with the Groundhog Day. Yeah, it does feel like we're repeating the same story. I remember 6 years ago, the topic was, the year is going to be the year of tokenized assets. And we have been saying that every year since. I think something has actually changed this year. We have MiCA on one side, and we now have, several exchanges that have received their licenses. So for the first time, we're now able not just to tokenize financial assets, but you also have secondary markets. I think that was missing so far, that there were no markets to trade these tokenized assets.
Clarisse, you've been in the old banking system for a long time. Sometimes for us crypto people, it seems like the old industry is trying to slow down the process because they stand to lose a lot in the game. What do you make of that?
Yeah, can I just kind of come back to your last point before answering your question? I think what was missing up until pretty much last year is not half of the world, but a big part of the world not complying with any regulation and making it impossible for any global player to actually have global operations on crypto. So what's happening in the US, in my opinion, is very important for our market, for the digital asset market at large. We had one piece of regulation in Europe, in Asia, in Middle East, but once again, we're missing a massive player to be able to start, building global operations. And I think that has changed tremendously, right? We were attending DAS events 2 weeks ago. Things have completely changed, right? The United States is back on, and all the banks in the United States can now actually build products that are not just dependent on the OCC, but on the SEC, right? Because they're starting being much more comfortable. So hopeful that the conversation will improve and that we'll be talking about actual use cases that are live. And maybe to come back on that one point, I think the arbitrage people have been excited about blockchain industry, but could not touch crypto. Crypto is still the biggest market, right? And so we've all been spending, a lot of time thinking, okay, what is the first use case and what are we going to actually start building with? And so a lot of the initiative POCs that have been around were kind of removing or cannibalizing a bit of the product and the revenue source for all these players. And I think what has changed as well is that we've now discovered that tokenization of cash, whether we're talking about money market fund, whether we're talking about collateral, whether we're talking about stable coins, is actually adding capital efficiency. And this is a use case where people see some accretive revenue. It's something that is adding revenue. It's a net positive.
I think that's an extremely important point you just made. Our industry doesn't just need to replicate what's already there. We need to add new use cases, new revenue streams, and that has been a little bit missing. Yeah, as you said, crypto was the only use case, and now just going and tokenize a bond, tokenize a share, that's not enough. There needs to be more.
Maybe, so I remember my first conference for blockchain, it was in 2016. I had a question about what's your prediction for the adoption. I was telling 2019. So I will not tell you that it will be for 2028, but I have made my first proof of concept for the funds. It was in 2016, to be honest with you, when we had some clients that were coming to the bank so to my previous bank, during the year 2017, 2018, they were telling us we want to invest in Bitcoin, but we were for a bank we are highly regulated. We cannot do, of course, what we want, and we need to have the clarification from the regulation. And as we said, with what has been done in US, with what has been done with MICA, with what has been done, so I'm based in Luxembourg, with the CSSF Q&A, we know exactly what we can do now in terms of business. So this is a missing piece of puzzle that was needed, and now, from my perception, we should move forward, and we have all the green light to move forward.
We have 4 European companies here today on stage. That there isn't an American one. It feels like with MiCA and all the regulation that Europe had an edge for a certain time. Now with Trump coming in, it feels like this edge has been lost. And if I talk to our portfolio companies in the US, there's so much momentum in the crypto space. How do you see that? Have we lost our edge, or have we never had it in the first place, or doesn't it matter? Andy?
No, I don't think we lost our edge. I mean, we had time to prepare. MiCA took a while to evolve. Institutions, took time to prepare for MiCA. Things are not going to happen overnight in the US. They will happen faster than here in Europe, but it's still going to take time. So we have still an innovative edge, and I will guess that a lot of strong European players will become active in the US. But US, I'd say 5 years from now, probably US will be again ahead of Europe.
Clarisse?
I'm aligned with, I'm sorry for the no controversial point, but I'm quite aligned with what was said. They will move fast, right? Have we lost our edge? No, because we've built a framework that they're going to have to heavily inspire themselves from, right? So every single European every single player that is compliant with the regulation in Europe will have an easier access into the US, and will have actually, capitalized on educating their workforce and being prepared. I think what's very unique though is that it's not just that they're catching up, is that it's becoming a strategic initiative, right? So it's becoming something that is a mandate for the United States to be a leader in that space. And there, without similar initiatives in Europe, without actually countries saying that, okay, maybe we should also put Bitcoin in reserves in Europe, right? To kind of make sure that we also catch up, attract all the asset managers, investors, and create that market. I think that's going to be a difficult one, right? Yes, of course.
And perhaps I'd add to this, and with the disclosure that I'm South African, so I hope I'm a neutral party. I think part of the challenge is cultural. And the reason why I say this is because if you look at the BlackRock approach to launching an ETF, it's like, let me sue my regulator, we're going to make a huge noise, we're going to go out, we're going to distribute this thing. And as Laurent mentioned, I looked it up. I mean, Coinbase had an ETP within Europe in 2013. I believe. So, I mean, it's really early, but there were a lot of new players, if I can use the word, that launched ETPs, not so much the traditional players. And for example, and I don't want to mention the particular name, but you have some traditional German organizations that launched crypto ETPs, and they have like very poor numbers in terms of assets under custody, or AUM. It's not because they couldn't promote it or they couldn't attract the assets. It's because the approach was, let's just try it and see, but not promote it too much because it's a little bit risky and we don't really want to be the face of this. And I think that's what's missing. We have to actually be quite bold and say, well, I'm willing to own that I have an offering in the space, and that can be difficult for large traditional organizations.
So if you are just looking to the top 20 companies in the world, 17 are coming from US. If you are taking the top 20 banks in the world, 7 are coming from US, just 1 from Europe. So and for the asset management, I believe they are all coming from US. The first one in Europe, I believe it is Amundi. So if you are just taking the 3 different ecosystem, yes, we did not lose the, I think that a lot of things is happening in US because they have the cash, because they have the company, because they have the culture, because they have the ecosystem. In Europe, yes, we need to move forward. It's not a question of we have lost time in Europe. We have built the framework. I fully agree with you. But yes, in the US, they have the cash. They move forward. But we should not forget Asia. And we should not forget Dubai, Abu Dhabi, and all the different countries. So anyway, we should see where the competition is.
Can I add?
Clarisse was first.
When you're raising funds, people ask you about time to market. And when you're selling to banks, they ask you, okay, but when are banks, starting building? And I think this is a question we've been thinking about a lot. And is it, when is banking on chain? Is it in 5 years, 10 years, 15 years, 20 years? Because we're talking about, those time horizon. Having said that, I think I'm very convinced that with that the adoptions for banks and the adoptions for digital assets in general with banks will actually come from retail. It will come from the ability to see that retail investors can actually buy and hold digital assets and start kind of, having this movement coming from the ground up. And so to come back on your point about the United States versus Europe, when I see the initiative from BBVA that was announced a few weeks ago, launching buy and hold Bitcoin and Ethereum for their retail investors, there's going to be a similar initiative in France, in Germany, this year in Europe. This is huge. We're nowhere close on that front to have that happening this year in the United States. And I really do think that will change the way top managements think about digital assets. It will embed the infrastructure within the system, and that's how you'll start really be able to build much more tokenized assets, much more initiatives involving blockchain. So I still think we have a hedge.
Andy.
I wanted to mention, the whole aspect of venture capital. So far the institutional adoption crypto assets has been, driven by European companies, and because, nothing was happening in the States, it was difficult for these companies to raise from U.S. investors. Now we know U.S. Has much more capital than Europe. Valuations are higher. So I think one change that we'll probably see is that American investors are becoming much more active in our space, which will again foster innovation across the globe.
Okay. Sarah, we have 5 minutes left, is that correct? There is nothing. Oh, sorry, this one. Oh, that's wonderful, that's wonderful. Yes, absolutely. Because just coming back on this thing, because Europe and America, it seemed like a paradigm change, like the move to crypto, would be a window of opportunity for Europe to establish a lead in an industry, just like the Chinese now with the changeover to electric vehicles become dominant and leave the traditional car industry in the dust. I was wondering, 2 years ago, we had this annus horribilis with FTX and all the other players. In the old traditional world, we had the Lehman effect. What is your theory of what is a possible Lehman moment that we could see in crypto, and what could we do to avoid it? Because that is an institutional play, that's not a retail player. What could happen and how to avoid it? Who wants to go first?
I think we had many of these Lehman moments already, right? Every time a big exchange blew up, FTX, Bybit, we had a Lehman effect. We had these crypto winters. And I believe, those weren't the last ones. We're going to see more like that. Obviously the whole regulatory aspect. We have this regulatory regime evolving around the globe. There are different approaches. Regulation can foster innovation. It can stifle innovation if it's done the wrong way. That could have some effects on our industry.
Yeah, I think, when you think about the Lehman moment, it's 50 years of regulations that still led to the Lehman moment, right? So We're gonna have a few more probably in crypto, but also bigger, because when we're talking about this type of crisis, we're talking about systemic crisis, right? So we're all thinking about the regulations, you know, obviously having in mind the risk of institutions failing, but the truth is that they are being conceived in normal scenario, not in stress scenario. And I think when you go back to Bybit, what's interesting is that you saw Binance rushing to save Bybit, right? To actually make sure that we don't go through a Lehman moment. It was almost a Lehman moment. It could have been a Lehman moment, another one, right? But this was actually prevented at that point. So security is one of them. I think the industry is maturing. We're going to see now new, in my opinion, we're going to see new crises more around the structuring of tokenized product. Where is my underlying? Is my underlying really my underlying? Are my reserves really the right reserve that I'm declaring? I think, you know, for all players that are either not regulated, these are things that can be very hard to audit, right? And so I think on that front, this is pretty much where we're going to see potential systemic crisis in our industry. And then I think we'll need, you know, layers and layers of regulations. So yeah, we're still very early, and unfortunately, I don't think that FTX was it, and they're going to be more crises in the future. Yeah.
Lehman was also heavily regulated, and it happened. What's the worst thing you don't want to wake up in the morning?
To lose my bike.
Besides the bike, of course. I mean, crypto, if I may just add, with crypto, for example, custody, it seems like so binary. If you have a hack, you're about to lose your business and your company will go down. Now, how to avoid that? If a bank gets hijacked, it's not the end of the world, usually. But with crypto, it may happen.
I think this is why you have frameworks like DORA, right? I mean, when you look at DORA requirements and when you start actually operating on digital assets, I mean, first of all, DORA is way wider than digital assets. But if you're actually building your custody in-house, you're going to have to show your disaster recovery, your BCP plan, make sure that you actually have redundancy. If you're using a third-party provider, you need to have 2 third-party providers, right? So I think, and this is also what's been good with the regulation, making sure that we converge to a framework that is the framework financial institutions are already operating in, is that we're preventing from this catastrophic scenario to happen by actually putting layers and layers of security. So yes, it's irreversible, but you can obviously equip yourself in such a way that you have layers of buffers before any catastrophic scenario happen. And once again, not reinventing the wheel to me, it's important. There's a new technology, you need to secure it different way, but banks have been securing private keys for the past 70 years. The first HSM was deployed in a bank in 1970, right? So there's nothing completely new in the way we do things today. We just need to adapt within the frameworks that those players have been operating with.
Stephanie?
So I think that sometimes it's not really very constructive to paint the doomsday scenarios, but to answer your question, the 2 things that I would be very worried about, the one is when we get to a point where we can all self-custody our assets. Imagine a bank run when everybody can self-custody their assets, right? It's kind of another level of how quickly you can withdraw your funds, and you have an alternative to standing in a queue outside of a branch, if you want, like the Lehman moment. And then the other thing is stable coins, and that's where we have really a strong advantage within Europe around the MiCA regulation. That's one topic that I think could have a very big impact if you have a settlement currency that gets disrupted.
And it's part of the requirement to set up the worst case scenario. So I can give you what we have in the worst case scenario. It's definitely the cyber attack. By the way, we have a solution called storage, and we have very good cyber security expert in the banking industry. So we do the best to avoid any attack in the future. So for me, it's the cyber security attack.
You ask what's the worst thing that could happen overnight. I'll speak not just for myself, but for the institutional players that are active in trading, that offer some sort of trading services to their clients. I mean, volatility is not bad. Our market lives from volatility. Prices go up, prices go down. That's not a problem. But the worst thing that can happen is that you have retail clients. Something happens overnight. They want to sell. They place an order. Next morning, people come into the office, and those orders haven't been executed. That's a big problem, and this has happened in the past. This is something us vendors, providers, banking institutions need to make sure that doesn't happen. The markets, crypto is 24/7. They need to be accessible 24/7. If a retail client wants to buy, wants to get out of his position, he needs to be able to do so without any interruptions.
And Clarisse, you're in the security space, so to speak. I mean, how do you avoid a hack like Bybit to happen again? How was it even possible, if you could explain to the everyday man how this haste got pulled off?
So Bybit did not get hacked, right? Safe did get hacked. And I think this is where, when I come back...
Can you explain the difference?
Yeah, the difference is that pretty much, and this is my point about corporate security, what happened is that the Korean group, right, the hackers, actually looked at all the employees of Safe, did a lot of work, research on how they were operating, and this was very much of a social engineering attack where they were able to hack one of the computer of a key employee that had access to actually the AWS root access of Safe, and from there they were able to actually access the Safe organization, modify the safe contract, and it was actually a UI hack right on the front, right? So that means that what you saw was not actually the transaction that was being displayed on Bybit's SAC. But Bybit was very hard for them, almost impossible for them to find out. So the truth is that it was not 1.5 billion that were at stake. It was all clients of Safe for one reason, which is corporate security. So once again, to me, it's all about we're operating in new risk. Yes, digital assets, blockchain actually is an irreversible technology, and so it comes with a new risk, which is, if you lose your private key, you lose everything. That is a new risk, but it's not a new risk we can't handle. Once again, there's very old technology, like you were talking about cold storage, so hardware security modules that have been designed to secure those private keys. There's new technology that are more suited to actually secure those private keys in hot environments, such as multi-party computation. Multi-party computation, MPC, is yet not standardized. The industry is working to actually get NIST standardized and make FIPS certified the library of the MPC technology. So this is super important that collectively we all contribute to this process to make sure that our foundations are very secure. But my first point was we should not reinvent the wheel. And so when you're entrusting a company with your digital assets, you need to look at, are they SOC 2 Type 2? Are they certified? Are they ISO 27001? Who's their auditors? Who has been actually doing the due diligence? How many controls are they actually auditing? Those are very, kind of basic corporate security that are absolutely fundamental, without which you're putting all the infrastructure you can ever build at risk, right? So to me, it's always a mix of leveraging new technology, making sure that collectively as an industry we build standards around it, but also having in mind that it's been, once again, 70 years that we are securing computer networks, right? And that we have good practices around access management, identity management, etc., that needs to be in place.
The effects of such a hack are just so brutal. I mean, there's so much money at stake. I have a final question for all of you. We're 2025, let's say in 10 years, 2035. Let's say institutional players dominate crypto by then, 10 years from now. What is one piece of today's market infrastructure that will look totally different in 10 years? Laurent, you want to start?
The secondary market for tokenized product.
Can you elaborate?
Yes, of course. So now if you want to buy crypto, for example, you have a secondary market, you have the possibility to do execution, you have the volume and so on. But if you want to buy and sell and to have a trading facility for the securities token, like funds, like bonds and so on, you do not have sufficient volume to make it happen. So you have the possibility to tokenize, you have the possibility to custody, but today, in terms of tokenized product, the secondary market is not big enough to have the adoption. So this is, for me, just one missing puzzle.
So I would say it's more the settlement layer, right? So the behind your secondary market, effectively, a lot of the back office processes, for example, that could potentially be disrupted. So these, I don't think the disruption will happen first within cash equities, because that space is already quite efficient. But you can envision one day where functions like a CSD or CCP have changed completely.
I think that the entire settlement layer, cross-border payments, that will evolve massively over the next 10 years. We're still at a very early stage right now. Still, settlement happens over SWIFT. Cross-border payments are still a nightmare. 10 years from now, this will all be tokenized, seamless, you know, with being able to pledge your assets to an exchange, settle instantly whatever you want. I think this will happen in 10 years.
Except for countries with exchange control.
Fair enough. Agree with you. I think in order to make sure that we can start a secondary market and hence distribution, you need to have the settlement part. And for the settlement part, I'm a big believer that we need to have some sort of, if it's not stable coin, I think CBDC will be even more powerful, right? So you don't get the benefit of tokenization if you don't have instant settlement and on-chain settlement. So in my opinion, in 10 years from now, we get that leg, and then we can start actually building market, distributing, and getting the whole benefits of the technology we're leveraging.
Well, then let's hope that in 10 years from now, we won't see another Groundhog Days. Thank you so much, ladies and gentlemen.